Advanced Micro Devices is currently trading at $214.76, which represents a significant intraday drop of $18.13, or 7.78%. Now, seeing a drop like that on a high-flying semiconductor stock, the immediate assumption for many is simple profit-taking or a reaction to broader market jitters. The expectation is that this is just noise in a powerful uptrend. But the reality of what's happening today is far more specific and speaks to a deep-seated anxiety about AMD's most important story. This isn't just a broad market sell-off dragging a good name down. This is the market actively questioning the very foundation of AMD's recent valuation surge, the speed and profitability of its attack on Nvidia's dominance in the artificial intelligence space. What we are witnessing is a direct reevaluation of the timeline for AMD's AI ambitions, and it's happening in real time. The prevailing narrative, the one that has propelled AMD stock to incredible heights over the past year, is straightforward. The world needs more AI chips than one company can supply, and AMD, with its MI300 series of accelerators, is positioned as the only viable high-performance alternative to Nvidia. The expectation was that major cloud providers and enterprises, desperate for supply and a second source to keep pricing competitive, would flock to AMD. This belief priced the company not as it is today, but for a future where it commands a substantial piece of the data center AI market, a future that seemed all but guaranteed. Investors using everything from sophisticated interactive brokers trading platforms to simple SoFi Invest apps piled in, betting on this David versus Goliath story, where David was sure to land some very heavy blows. But today's price action is a stark reminder that reality is rarely so clean. The deeper truth is that challenging an incumbent like Nvidia involves much more than just building a competitive piece of silicon. The real battleground is the software ecosystem. Nvidia's CUDA platform has a 15-year head start, creating a deep and sticky moat of developer familiarity, optimized libraries, and a massive installed base of applications. The expectation was that the sheer performance of the MI300X would be enough to compel customers to do the hard work of porting their code or adopting AMD's ROCm software platform. The reality is proving to be a much tougher slog. We are hearing whispers from supply chain channels and industry contacts that while interest in AMD's hardware is extremely high, the software validation and integration process is taking longer than bulls had hoped. This extends the sales cycle. For a stock priced for flawless, rapid execution, any sign of a slowdown or friction in adoption can trigger the kind of repricing we see today. This isn't a fall from grace, but a recalibration of a timeline that the market had compressed to an unrealistic degree. It's a classic investment lesson. The difference between a great company and a great stock is often the price you pay and the expectations baked into it. Looking at the intraday trading dynamics, the volume is immense. We are seeing significantly higher than average turnover, indicating that this move is being driven by institutional players, not just retail investors reacting on their Robinhood app. Large blocks of shares are moving, suggesting that some funds that rode the momentum up are now trimming their positions, locking in profits, and perhaps rotating into safer assets, or even into Nvidia stock itself, viewing the incumbent as the safer bet during a period of uncertainty. This type of high-volume sell-off can create a cascading effect, triggering stop-loss orders placed by individuals managing their own individual brokerage accounts through platforms like Fidelity or SoFi. For anyone engaged in online investing, seeing a drop like this in a core holding can be unnerving, but it's precisely these moments that separate tactical traders from long-term investors. A trader sees a broken chart. An investor sees a potential opportunity to acquire shares in a strong company at a better price. The performance of Apple stock and Tesla stock over the years has taught us that even the biggest winners experience severe pullbacks. Let's ground ourselves in what advanced micro devices actually does beyond the AI hype. The company operates across 4 key segments. The data center segment is the star of the show right now, containing the EPYC server CPUs that have successfully taken market share from Intel, and of course the Instinct GPU accelerators designed for AI. The client segment covers the Ryzen CPUs and Radeon GPUs for desktop and notebook PCs, a market that is cyclical and sensitive to consumer spending. The gaming segment is also crucial, providing the semi-custom silicon for both Sony's PlayStation and Microsoft's Xbox, along with its consumer-facing Radeon graphics cards. Finally, the embedded segment provides chips for a vast array of other markets, from networking to automotive, a business that became significantly larger after the acquisition of Xilinx. So while the market is laser-focused on the data center AI story, it's important to remember that AMD is a diversified semiconductor company. Weakness in the PC market or a slowdown in console sales can and will affect the bottom line, regardless of how many MI300X chips they sell. This diversification is a strength, but in a market obsessed with a single narrative, any weakness in these other areas can be magnified. This is a level of detail that automated tools like Schwab Intelligent Portfolios consider when balancing a portfolio, but it's something every person engaged in self-investing needs to understand for their concentrated positions. Investment help often starts with understanding the whole business, not just the headline-grabbing part. The recent earnings report was a perfect example of this expectation versus reality dynamic. The numbers themselves were solid, meeting or slightly beating expectations, but the guidance, particularly the forecast for AI chip sales, while impressive in absolute terms, raised from $2 billion to $3.5 billion for the year, fell short of the whisper numbers circulating on Wall Street. The market expected a blockbuster forecast, a number so large it would undeniably signal that the market share capture was happening at lightning speed. When the company provided a number that was merely great instead of impossibly fantastic, the stock hesitated. It didn't collapse, but the seeds of doubt were sown. Today's sell-off feels like an aftershock from that earnings report, amplified by some negative sector-wide sentiment. Investors are now scrutinizing every data point, looking for confirmation that the growth story is still on track. They are looking at Fidelity ETFs that hold AMD and wondering if the concentration risk is too high. The ease of access to information and trading through a Fidelity mobile app means these sentiment shifts can happen faster than ever before. Comment below with your price target for AMD by the end of this year. Are you buying this dip or waiting for more confirmation? Looking ahead, the path forward for AMD is defined by this tension. The optimistic scenario is that these adoption hurdles are temporary. The bull case rests on the idea that the second half of this year will see a massive acceleration in MI300 shipments as those initial software validations are completed. If major customers announce large-scale deployments and AMD can show that its gross margins on these products are holding up better than feared, then the expectation narrative will come roaring back. In this scenario, today's drop will look like a fantastic buying opportunity, a mere blip. People using various investing sites to invest online will see their conviction rewarded. The more cautious scenario, the one that the market is flirting with today, is that the software problem is more profound than bulls want to admit. If Nvidia's next-generation Blackwell platform extends its performance lead and the CUDA moat proves unbreakable for the most critical, high-value workloads, then AMD could be relegated to a permanent, lower-margin number 2 status. In this reality, its growth would still be respectable, but it wouldn't justify the premium valuation the stock has held. The company would look less like an AI hyperscaler and more like a very well-run, diversified semiconductor firm, and its stock would be re-rated accordingly. This is the primary risk that anyone with an individual brokerage account at a place like Fidelity Investments or Interactive Brokers most contend with. Fidelity mutual funds that have a heavy tech weighting are certainly feeling this pressure today. Short disclaimer: this content is for educational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before investing. All investments carry risk, including possible loss of principal. Short, like, comment, and share outro. If you found this helpful, like, comment, and share. Don't forget to subscribe and hit the bell for more smart money tips.